All right. Do believe we are live? Welcome everybody to live valuation. I'm Midas Moriarty. Just give me a moment. Sure everything is up and running in the appropriate locations. Uh, there. Okay. So today we're going to be looking at Liberty Global, a very large telecommunications player throughout Europe, UK. They have been showing up on many major institutional and hedge fund 13Fs the last several quarters. I've definitely been kind of curious about this one for a long time. It's kind of been on the back burner. There were a number of reasons that made it seem less appealing several quarters ago when I was kind of like looking initially. I was like, I don't know, I don't really, that doesn't seem like something I want to look into. But I've been looking at it a little bit more, kind of like come around to a slightly different perspective. I was like, at first I thought this business was a little bit more of a messy conglomerate than I think it actually is. And then, like I said, the fact that it's just been on so many 13Fs for so long has kind of had me curious for a long time. So we're definitely gonna take a look at this one. We'll see what it comes up to be. Has a little bit of a strange capital structure with three different classes of shares: the A, B, and C. B being the kind of insider founder class of shares that are being converted into A, and then C, non-voting class. I'm primarily valuing this based off of the A class shares. LBTYK is the C class shares that also trade on the Nasdaq. If they're not really that different, there's just a like 50-cent change or whatever or so, or not even 7 cents change, which is essentially the implied discounted present value of the voting rights, because that's essentially between the share class. So I just point this out because I'm, like I said, I'm doing class A shares, but technically if you want to look at the same investment, you could go for the class C shares, which is under the LBTYK, and you could get a slightly cheaper price for effectively the same earnings. I'm going to be going for the voting class shares. Not that voting makes a huge difference in the perspective of it, but just on the off chance that for minority shareholders get screwed over by majority shareholders or something by like differing dividend rules or something. Unlikely to happen, but the point is unless there's a significant discrepancy and you have a very large reason to maybe want to bypass the voting shares, you should always go for voting shares. Essentially is my point. So whatever. I'm gonna play the earnings call. I have not done a lot of like the early work stuff, so we might be running a little bit behind on this. Why is this only 14 minutes? See the full call? Did I not? Actually, hold on a minute, maybe. Events. Oh, was that only the schedule called? Did I? Not earnings release. My bad. Being a little dumb here, Derek. I don't know if the third quarter earnings isn't actually going to be. Well, it's not yet available. Why? Yeah, yeah. It's not scheduled for November. I don't know why I was clicking on that one. we'll go ahead and actually just listen to this Goldman Sachs conference. Assuming it's available. Gonna play? It really just does not want me to listen to anything, apparently.
Good morning, ladies and gentlemen, and thank you for standing by. Welcome to Liberty Global's second quarter 2021 investor call. This call and the associated webcast are the property of Liberty Global, and any redistribution, retransmission, or rebroadcast of this call or webcast in any form without the express written consent of Liberty Global is strictly prohibited. At this time, all participants are in a listen-only mode. Today's formal presentation materials can be found under the Investor Relations section of Liberty Global's website at libertyglobal.com. After today's formal presentation, instructions will be given for a question and answer session. Page 2 of the slides details the company's safe harbor statement regarding forward-looking statements. Today's presentation may include forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995, including the company's expectations with respect to its outlook and future growth prospects, and other information and statements that are not historical fact. These forward-looking statements involve certain risks that could cause actual results to differ materially from those expressed or implied by these statements. These risks include those detailed in Liberty Global's filings with the Securities and Exchange Commission, including its most recently filed Forms 10-Q and 10-K as amended. Liberty Global disclaims any obligation to update any of these forward-looking statements to reflect any change in its expectations or in the conditions on which any statement is based. I would like now to turn the call over to Mr. Mike Fries.
Thanks, operator, and hello, everyone. As always, we appreciate you joining us today for the Q2 results call. We've got a lot of ground to cover, so I'll begin with some operating results and a deep dive into a couple of topics that I'm sure will be of interest to you all. Then after Charlie covers the financials, we'll get right to your questions. I'll kick it off on slide 4 with 5 key headlines that should capture the broader narrative of the quarter and our value creation opportunity. First of all, our goal of creating FMC champions in our core markets is working. We made a very conscious and deliberate shift in our strategy 4 to 5 years ago, which saw us exit subscale markets at premium multiples and concentrate our resources into really 4 key countries where we become fixed mobile champions. I'm going to illustrate this more fully on the next slide, but despite reducing our geographic reach by 40%, we increased aggregate revenue by 40% and now serve a larger base of 85 million fixed to mobile subs. And those FMC champions are driving scale and growth, supported by unrealized synergies of $12.6 billion from our last 2 deals in the UK and Switzerland. That's on an NPV basis. And by the way, given our ownership, over $8 billion of that will accrue to our shareholders. Second, the demand for fast and reliable connectivity in Europe continues to anchor strong commercial momentum across our footprint. I'll speak to the numbers in a second, but we reported good revenue and subscriber growth and a standout quarter from Virgin Media O2. Third, we've talked quite a bit over the last year or so about our network strategy options. Yesterday, we made a big move in the UK, announcing our plans to upgrade to fiber across our footprint. I'll speak to that in a moment. But the main takeaway is that we have great options in every market, and one size will not fit all here. To answer the question preemptively, cable and DOCSIS will continue to play a big role even in markets where we intend to upgrade to fiber. And given our speed leadership today and heavy investment in fiber-rich HFC, we can approach this moment in an offensive posture with a clear focus on free cash flow and accretive returns on capital. Fourth, it's becoming increasingly hard to ignore our ventures portfolio. which has been valued by third parties at $3 billion or about $5 per share. That's around 20% of our current stock price, and I'm guessing very little is being recognized today. We're going to continue to provide greater and greater transparency of our tech, content, and infrastructure investments. Now, these strategically align with our core operations, and they also benefit from our unique track record in telecoms and treasury and M&A. We also announced that we're engaged in non-binding negotiations with Iliad's Polish subsidiary to sell UPC Poland for $1.9 billion. That's about 9.3 times EBITDA. We don't normally announce these things, but Iliad was required to do so for other reasons. But I can tell you, these sorts of asset sales at these sorts of multiples should also help bridge the value gap in our stock. And then speaking of our stock, we're making a big commitment today to put our money where our mouth is. Rather than decide periodically how much and at what price we're going to purchase shares, we're announcing today our commitment to buy back 10% of our market cap annually for 3 years, which means we're adding $400 million to our current $1 billion program for the remainder of 2021. Now, I just referenced the transformation of our platform over the last 4 to 5 years, and we've been trying to find a way to better illustrate the transition to an FMC champion, and slide 5 does that, I believe. If you had asked me 10 years ago, do you think you could build a better, stronger business by exiting half your markets and concentrating all of your resources into a handful of fully converged fixed mobile operations? I probably would have said, I don't know, I'm not sure. But when broadband competition intensified, and cable consolidation slowed, and the demand for broadband capacity and mobility skyrocketed, we rapidly pivoted and are a much stronger and more valuable company today for it. That involved 4 key steps. First, of course, we exited 5 subscale markets like Germany and Austria at premium multiples to mobile-only players like Deutsche Telekom and Vodafone. Aggregate proceeds were $25 billion, and these guys needed a fixed network solution in their markets. On one hand, this validated the underlying private market value of our cable operations, something we continue to demonstrate even today with the potential sale of Poland. But on the other hand, it allowed us to focus resources on those markets where we had a pathway to fixed mobile convergence by acquiring or merging with mobile operators, specifically in Holland, Belgium, Switzerland, and of course, the UK. So even though we shrunk our geographic footprint by 40% with a concentration in 4 countries, we have 25 million more fixed to mobile subs than before, 85 million in total, and 40% more revenue, 24 billion in total on an aggregate basis, with a very balanced blend of fixed and mobile revenues. Now, the benefits of that fixed mobile transformation are showing up in our results. It was a solid quarter for our businesses, really across the board, as you can see on slide 6. We delivered positive revenue growth across all 4 key markets. Charlie's going to walk through the details, but VodafoneZiggo grew 3%. Telenet and Virgin Media grew 4%, the latter representing just the 2 months prior to the merger. By the way, for a good look at pro forma financials of Virgin Media O2 for the second quarter and restated for prior periods, take a look at their fixed income release. We can't provide that data in our GAAP presentation this quarter, but we'll do that going forward. You'll see that Virgin Media O2 combined revenue was up slightly in the quarter, and EBITDA was up 6% on the back of cost control and commission savings in the mobile business. It was also a good quarter for broadband and postpaid mobile net adds, which totaled around 250,000 in the quarter across the group on an aggregate basis. And here on the top left, we do show full quarter results for Virgin Media O2, which added 22,000 fixed customer additions, our 5th straight quarter of customer growth, by the way. And that was supported by 36,000 broadband net adds, up 8% from Q2 last year, and 65,000 postpaid mobile adds. You can see on the bottom left, we continue to benefit from convergence, with total fixed mobile convergence ratios up to over 40% in all operations. Virgin Media O2 now sits above 40% with the addition of the O2 mobile subs who subscribe to Virgin, and Switzerland's at 56%, which is clearly a medium-term target for every market. And the right-hand side of the chart provides some operating highlights for each of the big 4 opcos. I'm not going to go through all of this in detail, but Virgin Media O2 is off to a great start as of June 1st, with record fixed sales in the month and strong mobile ads. The team is working on some exciting commercial offers and is focused on driving the benefits of an expanding 5G presence and the availability of 1 gig broadband across 100% of the footprint by year end. Sunrise UPC continues to benefit from strong sales momentum and the early rollout of FMC offers, with 6,000 broadband ads and 41,000 postpaid mobile ads in the quarter. The integration in Switzerland is right on track. In fact, the team just raised the synergy target by 50 million Swiss francs, which after cost to capture brings the NPV of synergies to 3.7 billion, up from 3.1 billion. VodafoneZiggo delivered its 9th consecutive quarter of revenue growth with fixed ARPU increases and mobile postpaid ads offsetting the loss of broadband subs. And with 5G rolling out and 1 gig services rolling out there, the company is well positioned to deliver its 2021 EBITDA and free cash flow guidance. And then finally, Telenet continues to be our most innovative operator, launching yet another converged fixed mobile offer called One, which helped the company deliver positive subscriber growth in video, broadband, and mobile for the quarter. So each of our 4 key opcos are performing well. Now, let me switch gears to a subject on slide 7 I know you're all interested in. I'm sure by now you've seen the announcement and read the press and analyst remarks about our decision to upgrade Virgin Media O2's fixed network to fiber over the next 7 years or so. We already have fiber to the premise to about 7% of our homes through the Lightning build. So we're talking about 14.3 million homes to be upgraded at a cost of about £100 per premise. Been lots of discussion around why are we doing this? What does this mean for cable and DOCSIS? Is this cost really that low? And let me start by reminding everyone that Virgin is today the undisputed speed leader on 15.5 million homes across the UK. Average customer speeds are nearly 200 megabits per second, with the balance of the market around 40 megabits or so. So speed matters in the UK. Of course, that's why BT is building fiber. But today, they only pass about 10 to 15% on our footprint, we believe. And we'll be offering 1 gig services to our entire footprint in 5 short months from now. So using an Olympic analogy, we all have our eye on advancing to the 10-meter diving platform, if you will, over the next 7 years with 10 gigabit speeds. But today, we're already standing on the 3-meter platform. And the rest of the market, in our view, just has their toes in the water at the edge of the pool. It doesn't matter how fast BT gets to 1 gig, we will always have an advantage. It's almost not a fair fight. Now, all of that is attributable to cable and DOCSIS, which will be part of our network solution in the UK for a long time to come. We're not decommissioning our cable network. Quite the contrary. We are simply expanding its capacity by pushing the fiber that's already there in the ground even closer to the customer. In fact, that's why we can upgrade for a fraction of BT's cost. We already have fiber deep into the network in mostly urban markets, and we have access to our own underground ducting that will require far less digging, and that's the most expensive part. And for these same reasons, upgrading the fiber is only marginally more expensive than DOCSIS 4, which is not the case in every market, but we made this decision pretty easy in the UK. Like everyone else, we will incur costs to connect the drop to the home, but that will be a variable cost based upon demand over time. It's also important to point out that these are gross CapEx costs, so they don't take into account the expected revenue uplift that could occur here. You can see some of those economic benefits outlined on the right side of this chart. Both DOCSIS 4 and fiber to the premise will make our B2C and B2B services more competitive, that's clear. But given the marketing halo around fiber that seems to be building up in the UK and the benefits of symmetrical services to the enterprise market, we would argue that fiber probably has a slight advantage and will derive more value. Similarly, while cable can do wholesale, just look at Telenet, the likelihood of deriving value from the £1 billion wholesale market in the UK, if we chose to do it, which is quite mature and busy, is enhanced by an all-fiber solution. Since we only cover half the country, it's safe to assume that wholesalers will want to keep their technology platforms simple and seamless across providers. And a fiber solution does that, of course. Now, beyond those economic benefits, fiber to the premise in the UK also provides greater confidence as we think through network expansion options beyond the steady Lightning build today. And we continue to evaluate that opportunity to add an additional 7 million homes, sort of a supercharged Lightning, if you will. And we're in good discussions with financial and strategic partners about what that might look like. So stay tuned. Now, in light of this UK announcement, I think it's important to stress that there's no direct read across to cable or other markets from this decision. Because the truth is we have multiple paths to 10 gig in every market, and we're evaluating the right path on a case-by-case basis. So slide 8 lays out how we're thinking about it across 3 approaches. The first, of course, is simply accessing someone else's fiber network, allowing us to avoid the CapEx associated with the upgrade and providing some measure of market rationality if others are pursuing the same approach. Now, Sunrise has successfully done this in Switzerland with the Swisscom wholesale arrangements. The negatives or costs are also clear, though. You're foregoing owner economics in your most important product, broadband, and you're somewhat exposed to fluctuation in wholesale rates, among other issues. Obviously, DOCSIS 4 will be a transformational technology development when it arrives, and it has a robust ecosystem of cable operators around the world, particularly in the U.S., supporting the innovation of the platform. As we've seen in the transition from DOCSIS 2 to DOCSIS 3 and then to DOCSIS 3.1, the costs are generally lower than a fiber solution as they build upon the existing platform before it, and the rollout can be faster. But on the flip side, DOCSIS does require a relatively substantial one-time investment in the active and passive components of the network to enhance spectrum capacity and speed each time you upgrade. It's also not clear when the technology will be available for commercial exploitation, but we are part of a select group of operators working together to accelerate that timetable. And then finally, while DOCSIS 4 will get us to 10 gig, there's no current roadmap beyond that or a forecast for what it will cost to get to, say, 50 gig. Fiber solves both of those future issues, of course. As our announcement today makes clear, building fiber to the premise is a real and accretive option for us in certain markets. I've already mentioned the clear path to 50 gig speeds, the benefits of symmetrical services, especially to the B2B market, and the significant opportunity that some markets offer around wholesale revenue. The price for that is higher upfront costs, which vary significantly by market. The decision about which path we'll take always comes down to a few key questions. And it's clear to us that we are likely to avail ourselves of all three options across our footprint and to varying degrees by market. First, of course, is the competitive environment. What other operators are doing, and are they building fiber? How quickly? Second, as I've just mentioned, is the relative CapEx costs associated with each option. That's obvious. Where it starts to get interesting is around the economic benefits that accrue from one approach to the other, specifically the positive impact on the B2C and B2B competitiveness, the size and attractiveness of the wholesale market as a provider or a user, and of course the strategic and financial partnerships you can form to support the plan. I can tell you that work is underway, well underway, in every market. You're probably familiar with Telenet's announced discussions with Fluvius to upgrade Flanders to fiber over time. Ireland looks a lot like the UK to us. Switzerland is likely to be a hybrid approach, and Holland is still in the early phases of analyzing the best plan, but a fiber-deep DOCSIS 4 strategy might make the most sense there. In the end, as we've done in the UK, we're going to be extremely focused on optimizing the medium-term and longer-term ability to compete, grow, and generate free cash flows and make those decisions in every market. Now, I'll end my remarks on slide 9 with a quick recap of how we intend to create value for shareholders from this point forward. And it comes down to three core pillars, if you will. First and foremost, we're going to focus on maximizing the value of our fixed mobile operations. Now, these are the crown jewels of our business. We've worked hard to build scale as a number one and number two player in each country so we can shape markets, radically innovate, and make the important strategic decisions that are going to underpin growth for years to come. How will we do that? Well, as you've already seen in Holland and Belgium, it helps when you have a near-term catalyst of synergies to kickstart growth and support cash flow longer term. We also know that in an increasingly competitive market, convergence is working. It drives cross-sell and upsell. It reduces churn and makes customers happier. Nobody debates that anymore. The key is to stay rational on pricing and put the real effort into seamless digital experiences that keep customers coming back for more. The end game in every market is to generate distributable cash to the parent from free cash flow, dividends, recaps, whatever source. That's the metric that matters to us, and that's the metric that will fuel our model. Now, as we provide more visibility to our infrastructure and network strategies, you're going to see that these are largely offensive, as I've just gone through. In many cases, like the UK, they come with significant strategic opportunities around new revenue streams, network financing, and strategic partnerships. Hopefully also a re-rating of our business. And then lastly, we'll always look for ways to create demonstrable and transparent value, either through asset sales, like the potential sale of Poland, and possible public listings in markets where there is serious pent-up demand for local telecom champions. The second major pillar is becoming too big and too important to ignore. And that's, of course, our growing ventures portfolio. With a focused investment strategy around tech, content, and infrastructure, in markets and services that are adjacent to our core operations, we continue to create value, whether that's by benefiting from some smart early venture capital deals, such as Plume or Skills, or watching some larger positions like ITV, Univision, or Formula E appreciate. We're also excited about our move into infrastructure, where we have a real right to play, given our track record in telecoms, financing, and M&A. All in all, the portfolio is valued at $3 billion, which I mentioned, about $5 per share, and is starting to realize cash returns. It's already returned $400 million to the parent. By the way, we've begun the process of monetizing hidden assets in our opcos, like towers in Holland, Belgium, and the UK. That could add about $2 per share net of adjustments in the opcos. And that's not accounted for either in the ventures group, it's not in that portfolio, or in our stock. So watch this space. And then the third pillar is our levered equity model, which is unique in the European landscape and distinguishes us from mainstream telcos in Europe. At the core of this strategy is the prudent use of leverage, in our case 4 to 5 times on a fixed rate currency hedged and siloed basis. And that creates the opportunity for recaps and greater equity appreciation. You all know and understand that strategy. But we combine that with a strong stock buyback plan that just got stronger today with our commitment to repurchase 10% of our market cap annually for 3 years. And again, that means we're adding $400 million to this year's $1 billion program, only 3/4 of which we've spent so far. And we'll seek to purchase 10% of the shares in 22 and 23. So that was a mouthful for me, I know. Let me turn it over to Charlie, and then we'll get straight to your questions. I look forward to addressing all of those shortly. Charlie, over to you.
Thanks, Mike. I'm starting by highlighting our strong performance in Q2, where we achieved revenue growth across all markets and consolidated revenue growth of 3.4%. Now, whilst there's an element of COVID recovery in areas like sports and broadcasting, there has been very limited recovery in areas like roaming, and we're seeing positive underlying growth across all our businesses. The UK grew 4.4%, which includes a roughly 2% benefit from premium sports, with continued strong convergence volumes and B2B performance driving growth. Telenet also realized strong underlying growth in Q2, though the near 4% growth rate does benefit from a €30 million year-over-year improvement in broadcast revenues. And as we guided earlier, Switzerland has returned to revenue growth, fueled by continued strong mobile volumes, B2B performance, and a consumer business that continues to stabilize through positive broadband sub-momentum. Whilst VodafoneZiggo continues on their trend of strong financial growth, posting a 3% year-on-year increase versus the prior year, which marks a milestone of 9 consecutive quarters of positive growth. Q2 saw growth across all segments, including mobile on both the consumer and B2B sides of the business, as COVID drags abated. On the next slide, we provide details of our adjusted EBITDA, where costs to capture synergies continue to weigh on results in the UK and Switzerland. Virgin Media performed in line with the prior year despite $8 million of pre-merger costs to capture, and it's worth noting that the recovery in premium sports revenues is offset by increased programming spend year on year, given the credits that we received in Q2 of 2020. The Swiss performance continues to improve, and a 3.1% decline is explained by $9 million of cost to capture and higher growth in related investments in marketing and B2B. Synergy benefits are limited in the quarter despite the recent MVNO migration back to our own network, as those savings will become apparent in half two. Telenet's growth rate was suppressed due to the acceleration of programming rights in the prior year period, as live sporting events were paused in the second quarter of 2020, the benefit of which was seen in the Q1 result. But taken together, Telenet achieved nearly 2% first half year EBITDA growth. And in the Netherlands, a 2% EBITDA decline was expected given the estimated €21 million impacts of COVID-related temporary broadcast suspension and a non-recurring settlement in Q2 of 2020. VodafoneZiggo remains on track for full year guidance. Focusing now on OFCF, we present a year-to-date view of our performance, illustrating the significant OFCF generation of our core businesses. Despite a headwind of $58 million of cost to capture, the consolidated group delivered 2.1% growth in the first half. UK OFCF grew 2.3% in the first 5 months of the year, and we reached a milestone of 2.5 million Lightning homes. We continue to build efficiently, and our cost per premise continued to trend lower, delivering a cost per home of £576 in the quarter. The Swiss team remained focused on the integration and incurred significant costs in the first half to achieve longer-term synergy realization. The $41 million of half-one costs to capture helped lay the groundwork for future network migrations, IT integration, and the alignment of the product roadmaps, including B2B, although OFCF growth in Switzerland would otherwise have been positive. In Belgium, OFCF declined around 1%, whilst in the Netherlands, OFCF grew 1.6% in the first half, as we continue to invest in the network and remain on track to have upgraded 80% of our footprint to 1 gig speeds by the end of the year. Focusing on our core Liberty Global performance metric of free cash flow, we delivered $717 million of free cash flow in half one. Our strong first half performance indicates we are on track for our full year guidance of $1.35 billion, which represents 26% year-on-year growth, with growth accelerating on a per share basis as we continue to aggressively retire our stock. As of July, we've retired nearly 80 million shares since the year-end 2019, and the next slide illustrates our year-to-date buyback performance. As you can see, as of July, we've repurchased $765 million of Liberty Global stock as we approach our initial $1 billion authorization. As Mike announced, we're committed to repurchasing 10% of our market cap a year over the next 3 years, which serves to increase the 2021 buyback to around $1.4 billion, supported by our significant free cash flow and our corporate liquidity, which includes a cash balance of $4.1 billion as of quarter end. Our ventures portfolio is currently valued at $3 billion, which reflects the full collar unwind on ITV, which we completed in early Q2, and the continued monetization of our skills stake, where we've realized over $80 million to date. During the quarter, we also announced the creation of our AtlasEdge joint venture with Digital Colony, utilizing our owned real estate to provide cloud providers, streaming services, and enterprises with high-performance edge-of-network facilities through which they can distribute low-latency applications and services such as 5G, gaming, IoT, and edge compute. We expect that transaction to close in Q3 of 2021. To conclude, we are executing our FMC strategy across all markets, with positive revenue growth across our markets, synergies validated in the UK and upgraded in Switzerland. In the UK, we're excited to announce a cost-effective upgrade to full fibre by 2028, and we're increasing our buyback program for 2021, whilst committing to repurchasing 10% of our market cap annually over the next 3 years. Finally, we are confirming all guidance targets, noting Virgin Media O2 management were not part of the merger clean team, and as such are in the process of validating the combined business plan. And with that, operator, we'll take questions.
The question and answer session will be conducted electronically. If you would like to ask a question, please do so by pressing star or asterisk key, followed by the digit 1 on your phone. In order to accommodate everyone, we request that you ask only one question. If you are using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. We'll pause for a moment to give an opportunity to join the queue. All right, we'll go ahead and take our first question from David Wright with Bank of America.
Thank you very much for taking the questions today, Mike. I'm going to begin with something a little bit more curveball, if you don't mind. The equity of your stock has been I'd say a disappointment over the last few years for you guys, obviously reflected in some recent buybacks. I know that you and John are very frustrated with the Telnet equity and the valuations given. You've managed to do all these deals recently without equity, and right now you're having to justify, this big capex spend in the UK to a market that's very focused on short-term cash flows, etc. When you are confident in the long-term value creation, and that's exactly that. I think the frustration that led Iliad's owner Xavier Niel this morning to basically say, well, I don't need to deliver those short-term cash flows when I know there is longer value to be created, and he's obviously made the move to buy the stock back in. Do you never find yourself sat around the table, and you, Charlie, and maybe John saying, just, why are we bothering with these equity capital markets? Why don't we just buy the lot in? We can lever up and we can invest as we know best to create value. So just throwing that out there, Mike, love to know your thoughts.
Quite a curveball, but not what we expected to start the conversation with. But thanks, David. I appreciate the question, and I understand the question. And surely every entrepreneur or CEO or chairman of a company that feels like it's achieving more than the market is recognizing wonders about those sorts of things. Why wouldn't we? On the other hand, I think it's important to point out that we are, in a way, buying out the public, right? When you buy $1.4 billion of stock this year and you agree to purchase another 10% of the market cap, by the way, not the market cap, the shares. So if the stock rises, we're still spending whatever it costs to buy 10% of the shares. I saw one analyst say, well, that's only $1.4 billion every year. That assumes the stock doesn't move. It's the number of shares. If stock doubles, we're still buying stock, that 10%. So we are, in a sense, doing what you're saying, but perhaps in a more measured way and perhaps in a less expensive way. If you look back, we have repurchased well over half a company at varying prices, but generally prices that are less than today's price. And for those shareholders who believe in what you're doing, it's a way of ensuring that they ride along with you in that slow, go private, if you will. And if there's only one share remaining and when you own it, you've done well. So we are, in a sense, doing the same thing, which is giving shareholders an opportunity to exit if they're frustrated, and understanding what we do know about our business. We're confident in putting our capital and our free cash flow to work to buy those shares. So that's all I'll say at this point. Those two businesses, you look at Altice and if you look at Iliad, they have their own challenges and issues. I don't think our shareholders would be thrilled if we put an offer out at 7 times EBITDA to take the company private. I don't think they'd accept it. So those are unique circumstances where perhaps those businesses have their own challenges that warrant those kinds of multiples. I think our business is worth more. I think most shareholders understand that, and those who don't, we're in the market every day buying stock.
We'll take our next question from Robert Grindle with Deutsche Bank.
Yeah, hi there. Thanks very much. I was half expecting some guidance around the dividend from Virgin O2 as a clue to where group free cash flow might be going. But you've taken the different approach by committing to your buyback, which you've just been talking about. Can you give us some background to the thinking behind this? Is it because you're not sure yet about the funding for fiber, supercharged Project Lightning, whether to go alone or with someone else, or is there some other rationale behind this approach? Thanks.
I think it's pretty straightforward, Robert. We have spent quite a bit of time putting together, we believe, a group of fixed mobile businesses that are strong, have great cash flow prospects, and great strategic and competitive positions. We also now have a very good handle on what the next 5 to 10 years of network and technology evolution means to those businesses, and we are increasingly confident about the value of those businesses. And so it seems to us a good time to put a stake in the ground and reinforce our commitment to the stock and the business, as we know more and have a better understanding of what our future looks like. So I'd say it's not a defensive move, quite the opposite. It's an offensive decision to take advantage of what we believe is an undervalued stock, and to show that confidence to investors, of course, by committing to a clear buyback strategy as opposed to an annual one where we let you know every 12 months what we might or might not be doing. Secondly, I think it's helpful for investors when we can demonstrate our willingness to not just use free cash flow, but also our cash balance. If our stock appreciates, which we fully expect it should, we'll still buy back 10% of the shares, and if that requires us to utilize cash as opposed to just free cash flow to do that, then we'll do that. That's also, I think, a great statement of confidence, plus takes a bit of an overhang off as it relates to those investors who feel like we should be deploying cash more quickly. So I can't see anything but good news in the statement. It's not defensive. It's hopefully something most investors appreciate.
Our next question comes from Akhil Dattani with JP Morgan.
Yeah, hi, good morning. Thanks for taking the question. Maybe I can focus on the UK, please. You mentioned, Mike, that at this stage, the Virgin Media management team are not part of the merger process. Obviously, they've not been in a position to update us on their plans. I just wondered if you could comment on when we might expect that. Do we expect that within the next quarter? Is there going to be a standalone event where they'll give us an update? So, how do we think about that? And I guess more specifically, when we think about the UK, there's a lot of moving parts, as you outlined in your introduction. What do you think are the biggest decisions and biggest strategic things that need to be thought through by the management team. And I guess the one that we think about a lot is the wholesale strategy. So maybe you can give us any sort of color on how you think about wholesale for Liberty. For Virgin, that'd be really interesting too.
Sure. I'll take the first one, and then Lutz is on. I'll ask him to address, how the management team's coming together, the progress he's made in the organization, and his commitment to the board of the joint venture as to when he'll feel we've got a really good handle on next year and the years that come, because lots of good work is happening there. I think the biggest decisions in the UK should be pretty self-evident, and I've kind of directly or indirectly mentioned some of those. Of course, as we commit to invest in fiber in the balance of our footprint that isn't already fiber, we want to be sure we're focused on those things I listed on the right-hand side of the slide, namely ensuring that we're getting the benefit of that investment in our B2C and B2B businesses first and foremost. Also, though, that we are examining opportunities to work with financial or strategic partners and potentially wholesale partners to further monetize and utilize that investment. We're specifically and by design not being concrete about those plans today because there's lots of work to do and lots of options to consider. But you should assume that we are looking at this purely from an economic and an offensive point of view, and we believe there are opportunities to explore the economic benefits that should derive from this network investment beyond simply being more competitive in the B2B and B2C space. We also have to look closely at our decisions going forward around network expansion, as we've talked about on many calls. And I think we're taking one step at a time. This is obviously a first step, but I think going forward, we will look very quickly at the potential to expand the network beyond the current footprint, and potentially do that with partners as well in an accretive way. So lots of big decisions that I think revolve around the network, but all of them in our minds taken with a lens, and you can bet that our partners at Telefonica use the same lens of what value does it create and what is the impact it will have on our cash flows and dividends. So we're being very, I would say, thoughtful about this, and we're going to make decisions in the best interest of all parties, including and mostly concluding shareholders. Lutz, you want to talk about the management team and how you're coming together on the broader strategic and operational goals?
Yeah, sure. So we have 4 priorities in BMO2. One is integrate to both companies. Second is keep and accelerate the business momentum. Third, transform the company into digital. And fourth, find the right path to the fixed network extension. On number 1, we had really a jump start. So we have the top 100 of the organization announced since a month. We have been just sharing our plan for this year with our board yesterday. So obviously the board has to decide now, and the minute the board decides, I think you will get your guidance. But I think what I can say is that this was very much in line with expectation from both shareholders. We are working now on a new 3-year plan until October, and after that we'll get our board approval and share the outline with you guys. And also we have already reconfirmed that the team is able to get to the 540 million run rate synergies. Why can we do this already? Because we've spent quite a lot of time on the pre-merger activities, so we built on a pretty strong foundation here. Business momentum, I think you've seen our momentum, right? I mean, in Q2 numbers, look at our competitors, look at what we are doing. So we are approaching this integration with strong business momentum, both across mobile and fixed. Digital, I think, is we shouldn't touch it now. I'm sure we'll find some time. We will transform our business entirely into digital and network expansion. I mean, it's right. Mike said it. It's a big step. It's an offensive move. We'll have business for us in, and now we talk about finding the right solution for these additional 7 million homes. Find the right balance, how to invest our capital into 5G and 4G capacity. and find the right partnering model. So a lot to do. Good start, good momentum. Back to you, Mike.
Okay, thanks, Liz.
We'll go ahead and take our next question from Nick Lyell with Societe Generale.
Yeah, morning, everybody. Could I go back to the wholesale strategy, please, Mike? Because, I mean, there's risks with this as well. So how are you confident you can protect the high ARPU retail subs if you were to do that? Have you thought through that yet? Obviously you have, but could you share with us some thoughts from the UK business on that? And any conversations at all with Ofcom? And could I just clarify, when you're talking about wholesale, you are including the cable HFC network to wholesale as well, or is it just the incremental fiber parts of the network? Thanks very much.
Look, those are really good questions, Nick, and I'd love to walk you through the exhaustive amount of analysis that we've done at both the Liberty and the Virgin Media O2 and Telefonica levels around all of this, but I prefer not to. I think it's safe to say that if we were to enter into any sort of wholesale provider arrangements or consider that as a long-term strategy, then we would have thought through the impact on ARPU, the regulatory impact, and the best technology solutions to achieve that. Better to not get into too much detail today. The announcement is plenty to digest for investors, and we want to focus on explaining how we got there and how we'll achieve that. But I think it's safe to say we have lots of time to think through how we exploit and monetize that commitment beyond the benefits to our own business. And I would just give us a little time to finish those considerations, and you will certainly have plenty to talk about over the course of the next few quarters. Sorry to be evasive. I just think it's a slippery slope. We could get into a lot of detail. That's probably not helpful here.
No, understood. Thanks, Mike.
You got it.
We'll take our next question from Steve Malcolm with Redburn.
Yeah, good afternoon, guys. Just on the UK fibre plans, can you maybe just help us understand what is so unique about the UK network? I should know this after a million years doing this job, but I honestly don't. That allows you to build at such a low cost relative to the network. Yesterday was saying €1,000. The fact that it's fully ducted, I presume you don't think there's any construction required at all. Is it you can blow the fibres directly into all the ducts for all the customers? And I guess alongside that, the Project Lightning experience, hasn't been seamless in the last 6 years. So maybe what lessons have you learned? What confidence can you give us that the targets you set out yesterday are going to be the numbers you actually do? That'd be great. Thanks.
Well, Lutz, you can prepare, and/or Enrique, a little bit more color on why we believe the numbers to be, of course, accurate and, as you point out, less expensive than our peers. Let me just make a comment on Project Lightning. We built 2.5 million homes at this point. I think your reference to slippage goes back 5 years, maybe 4 years, quite a while ago. Since that early moment, and I would describe that as a very early moment, it has been a machine, and we have been extremely effective, consistent, and predictable in our execution of network expansion in the UK. Our returns and our penetration rates have been exactly what we said they would be, and our capital costs have come down consistently as we access PIA and we get smarter and better at executing on this large construction project together with suppliers. So I don't think we have I think we are as active and successful and predictable as anybody in the UK market, and you can just talk to the suppliers that we work with to confirm that. Our credibility or ability to achieve this, in my opinion, is sound and really not that questionable. But Lutz or Enrique, you're welcome to dive a little bit more into the detail around the £100 if you'd like to.
Yeah, maybe Enrique, you start, right? Yeah, exactly.
Sure, I'll just make a couple of comments. First of all, the number is obviously an average over quite a few different scenarios, but in the case of this upgrade, this project, the majority of the process actually uses our existing ducts and our existing fiber deep DOCSIS network allows us to really focus the upgrade capital basically on a significant portion of the passive part of the network. There are construction, you asking your question, is it because there's no construction costs? There are construction costs, but it's significantly lower than when you're building brand new territory like we are today doing in lighting. And then the final point I'll make is that the significant commonality between both the technology as well as the construction mechanisms between Lightning and what we'll be doing in this upgrade. So we're pretty confident that we understand the process and that we will hit those targets.
Follow up, Mike. I think you said that OpenReach is now passing like 10 to 15% of your network with fiber. Can you maybe just update us on what you're seeing where they have passed it with fiber? Are you seeing any particular change in the sort of customer onboarding and offboarding dynamics in those areas?
Lutz, you can address that.
Yeah. So, I mean, you've also seen, Steve, that these new wholesale prices, right, are announced and will kick in. And for 1 gig, that is then £22. Today, right, the fiber prices are very, very high. And we watch it very carefully, but look at our net adds. So we don't see an impact at all at the moment. Will that stay the same? No, because we think that, right, if prices for higher speeds will go down a bit, we would see a bit more competition here. But on the other hand side, right, we have now more than 40% of our fixed customers having also mobile with us, and that will help us also protect our customers from churn.
The other point I'd make is we are already 1 gig pretty much, and will be at the end of this year, 1 gig capable across 100% of our subscriber base. It isn't as if BT or any OpenReach customer will be providing a superior product to us. It's really a Me Too product, and we're going to have the advantage of being there first across the entirety of our footprint, and we'll be marketing aggressively both fixed mobile products as well as 1 gig products well ahead of the vast majority of these operators because we're already there. This is what I meant when I said, it's not a fair fight, because if BT is building to get to 1 gig, we're already 1 gig. And we're just basically further supercharging our networks for the next 10 years by ensuring that we'll have symmetrical 10 gig when and if that market requires it. So hard to see us not being able to compete with any activity from BT or OpenReach, given the fact that we're so far ahead of them as we sit here today. The 1 gig product.
Okay. Mm-hmm. Thank you.
We'll take our next question from Matthew Harrigan with Benchmark.
Oh, thank you. Another angle on fiber, one of your large U.S. peers is taking much more of a parallel, network topology approach. It sounds like what you're doing is a little bit more complicated. So using another Olympic analogy, I hope Enrique doesn't get the Simone Biles twisties on the execution, because it sounds a little involved. But the other thing that was really interesting on your U.S. peer was, even though they have 1 million homes passed, they didn't even call out the cost of operating, simultaneously with over 1 million homes passed, because the costs on fiber were so low, albeit they're at less than 5% capacity. Can you talk about the cost savings on fiber? I know sort of the dictum with some people is you're going to get about 30% reductions in consumer touch costs and related capex. And then secondly, on the ventures portfolio, you've got a couple things that are, I think the valuation you're carrying is probably pretty safe and sane. You got a couple things that would probably have a lot of sort of Cathie Wood type appeal if there was a flotation, something like Formula E, as well as the edge computing. Could you talk specifically about some of the possibilities around Formula E and whether it's a complement or a displacement to Formula One? Thank you.
Sure, Matt. I think Enrique would echo the comment that a fiber network could easily and should reduce operating costs over the long haul. I think it's important to point out, though, in the UK, we're not decommissioning the cable network. We're going to continue to utilize the DOCSIS 3.1 plant that take us all the way to 2.2 gigabytes. So we'll be at 2 gig pretty shortly here on the DOCSIS plant, and we'll continue to utilize that plant wherever and whenever necessary, with the fiber really being an overlay as opposed to a replacement of the coax network or of the HFC component of the network anyway. They'll share tons of fiber to the cabinet, if you will. But beyond that, we'll keep the HFC network viable. So the costs will be there. Certainly there'll be cost savings long-term and CapEx savings long-term. But I think you have to remember that those annual cost savings may not be quite as significant. On the venture side, there's lots of assets within ventures that could easily find their way into the hands of other strategic owners, IPOs, et cetera. We have at least 8 to 10 unicorns in the tech portfolio, which is about 800 million of the 3 billion. And we have some relatively large businesses in the content portfolio. You mentioned one, Formula E, but we have a stake in ITV, which we have a relatively low basis in, All3Media, and some other assets. And so each of those have their own sort of storyline and opportunity. And Formula E is doing terrific. It's in its 7th season, coming back strong from COVID, with some really exciting things happening with the car and the technology next year. We've got Mercedes, Porsche, all the right manufacturers getting behind it, and the product just gets better and better. With I think we've got another 18 years of exclusivity with FIA on electric car racing, so it's going to be terrific to see how that platform evolves over the long haul. And we're always looking at ways to help our portfolio companies achieve their goals, whether that's through flotations or mergers or whatever, or fundraising. So stay tuned. We'll give you more information on those assets as they evolve.
Over time, are you more likely to have the mobile traffic on the HFC network as the emergence of some new technologies, some Cisco and others, or is that going to be on the fiber network, if you don't mind my asking?
Well, we do backhaul today, and Lutz can speak about that. We provide quite a bit of backhaul services to almost all the mobile operators in the UK, including we'll do so for O2, typically utilizing fiber. But I don't know if there's some other element to that, Enrique or Lutz. You can do it over both, but generally speaking, these circuits are fiber.
Yes, the mobile traffic is mostly on the fiber network, and will continue to grow in that direction. There may be opportunistic cases in which we use a portion of the HFC network, but it's really the F of HFC that is being leveraged here.
Great. Thanks, Mike. Thanks, Enrique.
Yeah.
Our next question comes from Andrew Beal with Arete Research.
Hi. I just wonder if we can develop the discussion about longer-term fiber cost savings in Virgin. I mean, as you blow or pull the fiber alongside the existing HFC network or coax, I guess you can choose whether you serve each existing or new customer via DOCSIS or fiber. And then longer term, you've got this OPEX saving when you switch the DOCSIS off. So what is your thinking at the moment? Will you put all the new customers or upgraders on fiber, or do you just do it for customers seeking a certain high-speed tier or symmetrical or other services? And then, how many years off are you thinking it is that you actually switch off DOCSIS in an area that you've previously passed with fiber? I guess I'm just really asking about the pacing of variable capex for replacing the coax drops with fiber versus the long-term OPEX savings opportunity, and what your thinking is there.
Yeah, it's the right question, and I think it's a little early for us to provide any guidance around what % of customers will require or want a fiber connection, and the cost implications of that. But you should assume we're working that through. We have worked that through, but in terms of disclosing that, I think it's a little premature. Enrique and Lutz can chime in here. I think the cable network will exist for quite some time, and will provide us with a seamless ability to serve customers who don't require either the benefits of a fiber network or the speed and capacity of a fiber network. That's a nice luxury to have, but we can get people up to 2 gigabytes, on the existing plant. So that's the basic strategy. As we move forward here, and the idea of a sort of further disclosure on Virgin Media O2's plan when it's developed. Maybe we'll do that. We'll take some time on one of our future quarterly calls and really dive deep. It's a little early to do that for the public today, but I think you're on the right point, in terms of what % of customers will require a drop in a new CPE, how quickly will that happen? You can make your own assumptions about that. We certainly have, but I think it's too early for us to put that in the public.
Yeah. I mean,
go ahead,
right. So first of all, we are in the luxury position, right, that we can plan the migration predominantly customer demand driven, and that means the customer then wants to have higher speed than 2.2 gigabit per second, right? I mean, Mike said at the beginning, today a Virgin Media customer is using 200 Mbit per second, then it's 2.2 gigabit per second, right? So that will take some time. That's number one. Number two, we have the luxury to have, well, in one area, we can have one home then on fiber, and the next home we can have on DOCSIS 3.1, right? So we are not forced to really migrate entire regions onto fiber. And I think number three, obviously, over time, we want to have a balanced approach to really use the capacity of the fiber network in balance with the 3.1 DOCSIS network, right? So these are the factors. And as Mike said earlier, right, the biggest driver for us is not the cost saving with switching off the network, right? When you sit on a Cooper network and end of story is 80 meg, then you have to think about switch off. When you sit on a DOCSIS network, and today we see easily we get to 2.2 gigabit per second, then you absolutely want to leverage both networks. What's driving it is the business opportunities across consumer, B2B, huge growth opportunity. When you think about our market shares below 10%, we have now a 5G network and a fiber network. Lots of things are possible, and then the wholesale opportunity. So I think stay tuned on that.
Okay, thank you.
We'll take our next question from James Ratcliffe with Evercore ISI.
Hi, two if I could. First of all, I noticed you boosted the synergy expectations in Switzerland, and there's also some additional cost to achieve. How does that affect the time frame for seeing the cost to achieve versus synergy split positive in that market? And secondly, just going back to the buyback, can you talk about the thought process around doing it as a percentage of market cap rather than, say, a fixed dollar amount or free cash flow plus a given dollar amount? Because this has the effect of, the more stock goes up, the more you'd be buying back. Thanks.
Yeah, I'll take the buyback question, obviously, and Andre, if you want to prepare some thoughts around the Swiss question. I want to make sure I'm following what you're saying, James. If let me clarify what we're committing to, which is to repurchase 10% of the shares outstanding at the beginning of the year, regardless of price, over these next 24 months. So the amount of the buyback or the dollar amount of that spend will vary depending upon the price. That doesn't mean we couldn't accelerate that if the price were lower, to perhaps anticipate one of your follow-up questions. But we would continue to commit to that if the price were higher. And therefore, seems to us that investors now will be able to incorporate into their thinking around stock price and growth at minimum of a 10% improvement in the share price, we hope, based upon the buyback commitment we've made. So it seems to us to be an easier and more predictable and more beneficial approach to buyback, meaning that we're committing to that 10% number. And if it were a dollar figure, hard to know what that impact would be, right?
Got it.
Yep. Andre?
Yeah, well, on your question, does the higher synergy expectation have an impact on the timescale of the realization? No, it doesn't. So we actually have seen that some of the assumption that we have taken on the realization of moving customers over to own infrastructure from whole buy infrastructure were more conservative than what we think is now realistic to achieve. And that does not really change the time frame. In fact, we have seen some synergies coming in even a bit earlier. You've seen in the presentation that we were alluding to
the MVNO migration being executed ahead of schedule. And overall, I would say we are rather ahead of schedule than behind, so no real change to the timescale.
Thank you.
We'll go ahead and take our
Operator.
next question from. Oh, go for it.
No, go ahead, operator. I wasn't sure what was happening. Go ahead.
We'll go ahead and take our next question from Ulrich Rathe with Jefferies.
Thanks very much. I have a question probably to Lutz. Does the fiber upgrade plan require in-footprint share gains in the consumer market? I understand there are opportunities beyond that, but in terms of literally the consumer market, is there an element here that you think you can up the share, the market share? Thank you.
Well, I mean, we are currently winning market share, right, with a speed advantage. And we have not made any planning yet what kind of market share we are planning to win over the next 10 years. And we haven't justified the plan by a win of market share in consumer. Right, I said early on, we have just started now after committing the budget for 21 to come up with a 3-year plan and beyond, and then we are working on that. But it's definitely an opportunity to keep our customers and also to increase share of wallet, so ARPU per home with our customers. If we keep winning market share as we do today, let's give us some time to figure that out.
Thank you.
I'd like to now pass the call back to Mike Fries.
Okay, thanks. Listen, appreciate you staying on with us. I know there's other calls happening today, so you're probably already on your way. But look, 4 key takeaways from my point of view. Growth continues in our FMC champions, and synergies are just now starting to show up. So that's going to be a positive tailwind here in the medium term. We're excited to start providing greater transparency around our network strategies, with the UK being the first of those announcements. And I can assure you we're looking at these things through an offensive and accretive lens. And we have the luxury of doing that because we have such a fiber-rich network to begin with and a strong broadband base as we sit here today. Pay attention to the ventures portfolio. It's growing in value and significance. And we'll keep you posted on the Polish deal, which is just another reaffirmation of the private market value of our businesses. And lastly, we're excited about the buyback commitment. It's a strong statement from us. I think that's something you can take to the bank, if you will, this year and for the next 2 years, and that's got to be useful for investors who want to see us deploy capital in one of the most obvious places, and that's our own share. So appreciate you joining. We'll speak to you soon. Have a great August. Bye-bye.
Ladies and gentlemen, this concludes Liberty Global's second quarter 2021 investor call. As a reminder, a replay of the call will be available in the Investor Relations section of Liberty Global's website. There you can also find a copy of today's presentation materials.
Okay, so got through that call faster than I can get through this. I'm only about 2/3 done with the financial statements. I had a few little slip-ups in there, and then also I still had to do that pre-work that normally I have done before the stream. So running a little bit behind the normal speed. Okay, there is only 9 years for me to do financial statements rather than 10, so technically a little bit shorter on that end. So 6 out of 6 years is a proper 2/3, not just a little bit short of it. But either way, I'm not quite. That payable will throw accrued capital expenditures, accrued interest, accrued income taxes all into the accounts payable. not deferred revenue, and not accrued. About 4K left of that, so 57,000. Is that right? 7.3. Okay. Woody. Okay. Now on to year 7 of 9. Alright. We'll be right back. Alright. Again. Alright, so do these last 3 years. 2014, cost goods, then still general and administration. Throw impairment in there. Depreciation. Negative out interest. Did I see a positive interest there? I did. Hey, we actually have an average share count on here. For some reason, we didn't have it on the last four. Kind of like a minor, not super necessary line, so I don't mind skipping it. I have the normal share count, not the average diluted share count. I do like to include it as well, so you can at least compare it to the EPS that people are commonly reporting. Because this is the number they use for reported EPS, so I like to at least record that number if possible, so I can use it for comparison to what other people are talking about. But I prefer a current EPS, not an average. Whoa, wait a minute. I have operating listed twice here. Um, hold on. Copy paste that cash flow statement correctly. Parts later, consolidated balance sheet operation statement. Yada yada yada. Cash flow. So 2014, right? That's the year really. Man, this is what I get for waiting till the last minute to do the prep work last night, and as a result, screwed up. Slap this bad boy in here. Rid of the merge cells. Sure, I can section. This here. 2014 post. Boom. Okay. Oh, that's right. Boom, bitch. Okay. There. There we go. Whoops. Never mind, damn it. Why I scrolled all the way to the top. Here we go. There we go. Okay. Man. So many copy paste. Okay. Alright, so now we can move on to the finance section. Payments. Purchases. Now on to sheet. Okay, 2 more years to go. This one's here. I don't have a share count for the last year, partially because 2 years on this year's financial statements. That's how I have 2012 as the 13 is actually my last one. So we're going to make use of the weighted average share count. Take our time. A little bit of a bludgeon make use. It doesn't really matter 10 years back. 3. Did I not include that? There we go. Okay, now onto the cash flow statement. Some of the changes in working capital. For capital expenditures, disposals, food acquisition, and financing, debt and equity. Net out repurchases. Then the balance sheet. Cash. Receivables. There. Now liability. Payables. Include deferred revenue. We will include derivatives, interest. Would do taxes if it existed, but now deferred revenue in the category. Plus programming, current, continued, other accrueds. Term debt. Equity. Capital. Deficit. Treasury. Okay. Now one more year to go. Okay. Make sure I'm not crazy here. Back to the income statement. Get this over with. No taxes. Okay. Now cash flow statement. Working capital. Disposal. Position that. Purchases. All right, now the final balance sheet. All we done. Eight. Liabilities. large. 6. Whoa. Did not include derivative instruments. Alright, other long term, 36. Okay, now equity. Okay. And there it is. All of the financial statements are finally done. Take a look. See what we've got. Now I can see the value is currently not showing. That's because it doesn't have a 0. Don't get overly excited about the price. Look at. Sorry, just looking at their portfolio presentation. Looking at their guidance. Guidance for 2021, but we're mostly through 2021. Very useful, and it's not even giving me revenue guidance, giving me cash flow, which is weird. Okay. Well, let's go take a look. Next 5 years. Here. We'll take a look at what the analysts have to say. 11 to 14 analysts saying negative 3.6% in revenue this year, and then negative 19% next year. Okay. With negative 54% per year EPS growth next 5 years. Somehow I think that number is not accurate. They don't have a 5-year EPS number for them. And sales, they have supposedly one analyst saying 22% this year and 1% next year. That is very strange. Usually Yahoo's is more up to date. And it also claims to be off of a larger number of analysts. Current year, they're expecting 14.65 billion in sales, and then supposedly 14.83 billion next year. And then on Yahoo, it's 11.55%, or 11.55 billion this year, and then 9.32 billion next year. So I do think perhaps Yahoo is taking the discontinuation into effect more correctly. That's the obvious thing there. Now, it's not necessarily the end of the world for them. This kind of comes into the same sort of situation that AT&T had in my many videos that I've done on their discontinued operation situation, which is to say that telecoms have a very low sales to capital ratio, as we can see right here, which comes from the high amounts of capital expenditures required to operate those networks. And so, and the margins aren't usually amazing either. Three-year average is 30%, 15% for 5-year average. I don't have 9 years. I mean, I do have 9 years. Why is it not? Still an S. 9-year average of 7. I have that problem in a lot of these. I do need to fix that. I don't know why the 9th year got dragged back to the 10th year. Oh, that's why, because it's supposed to be 9 intervals, but or that's what it was counting, but it's not. It's supposed to be an interval for these. It's only supposed to be an interval for growth, year over year or CAGRs. Okay, that's the issue. So it is supposed to be R, correct? Whatever. So we can assume either the 7% average or 15% average. I think with the massive 99% one that we have right there because of the discontinued thing, I do think it's probably smarter to use the 7% average, and then at that point that just helps counteract the negative years a decent bit. So probably better to assume maybe a 7% middle point. And like I said, I'm sort of assuming that it should have low margins because of low sales capital ratio and the high capital expenditures in this business. I'm sort of modeling my expectations off of my experience dealing with AT&T. So let's just assume that 3% maybe on the low end, 12% maybe on the high end. We'll give them a little bit of a better range. No, we'll just do it like that with 7 in the middle, and then we'll weigh the outcomes a little bit further, and then maybe 8% on that. Now the revenue is where things get tricky because of people's expectations, and also we need to drop the sales capital ratio down. Probably visit debt while I'm down here. Doesn't improve much there. R. Yeah, so basically the same. Doesn't shift around much. It's been slightly better in the last few years, partially because of the changes overs in their business that they've been working on. So I think that's just is what it is. Just do that and then weigh this to positive end as well. All right, now they're highly levered. That is where this gets a little bit tricky, and that's part of the reason this is so low at the moment, because we have this down at 0. I know that makes a huge difference to it. Plus, we're asking them to do a huge amount of sales growth with a really low sales to capital ratio. So once we adjust sales and debt, the price will probably jump up significantly. As he was talking about in the sales call, they're a highly levered situation. So if we push this up to 50, and then maybe push this up to 200, which gets us a distributed 110. That stays at 110. Or what? Whoops. This one. Where things get tricky because of the huge drop in sales expected. Because I still have a model that runs off of 5-year CAGR, so I don't have like a 1-year drop and then a kind of more consistent growth rate after that. I have a situation where you have to put the long-term average, meaning 5 years, in place and kind of just run with it. So I sort of have to make a broad range of guesses that moves past my assumptions as well as over it. So if it's supposed to be going to 9.32 billion, or let's say on the low end. On the low end, it's supposed to be 7.92 billion next year. Now you have to understand that from this year, this is 2021, so it would be this year right here. So this is 9.7 billion, which is supposed to be 7.92 billion. Now it's 7 billion at 3 years past that, so you have to think about where it would likely be after that. In a worst case scenario, you could assume maybe they lost a little bit more even after that 7.2 billion, maybe down to 7 billion. So minus 10% as a CAGR, I think is a pretty good low point to keep for that. It's a little over assumed on the revenue here, but it's a negative consequence down here. In fact, maybe you could lower it a little bit more. It's supposed to be the worst case scenario for the 3 years after that. So let's assume maybe negative 11% for that point. Now, if look at the high estimate for next year of 15.2 billion, a really, really, really huge range. That is exactly where I have the point for that point there. So it's 15.2 billion. And we assume today the treasury is 1.52. So we're going to assume that steady state of pretty high level steady state would be double that. So it would be 3% per year or so. We're going to assume 3% per year for the 3 years after that. They are telecoms, not really going to have a huge amount of growth beyond that. So you could assume maybe in the 5-year period out, it would be 16.6 billion. So that should be perhaps what this number is. Now this should probably be towards the lower end. Actually, probably high, honestly. Now, margins, things could get a little bit more arguable on where it should go. let's look at the returns on invested capital. Returns on invested capital over 3-year period says 17%, but obviously that's a little thrown off. 5-year period gets 12%. That's pretty good. 9-year, we probably have the same issue. Gets us 9%. It's not too bad, 9 or 12%. However, it looks like their weighted average cost of capital is pretty high though, because of the cost of debt as it's been coming out here, and then a pretty high cost of equity because of the high leverage. Yeah, I'm not seeing too much else to do with it. Looks to me like a pretty poor business. I mean, it's not got amazing margins. It could be that I'm wrong on the margins. It could be that maybe the 5-year average really does make sense, but I think this outlier is really throwing it. So the average without it is negative. But I think that's also sort of part of the point. The adjusted free cash flow that they're expecting in 2021 is $13.50. Hard to compare my number to theirs per se. Free cash flow to equity is after debt been put into it. And here's the required reinvestment, which is all negative across the board. So Yeah. Okay. I'm reasonably happy with those margins. That was just the part I'm kind of getting tossed up on. Like, this could be all screwy if I really am putting in too low margins. That would make a huge difference. I'm not sure how big of a difference it really makes, but yeah, it would probably be very undervalued no matter what. But it's too much debt. Too much debt. I'm seeing it. Definitely. Too much debt. Too much debt. Not enough margin. Too much reinvestment. Honestly, there's a lot of problems with it. It's a little surprising to me that so many hedge funds are in on it, though. This is all screwy to me. I mean, I know they're hoping on the massive decrease in the share count and everything. Oh wait, did I? One part maybe throwing things off. Really. Yeah, this company is just a total basket case, but not a very high quality business, regardless of that fact. So, not much about it appealing as a result. But whatever, we got it out of the way. One of the reasons I was also very curious to do it is because of the distribution of its geographies. Interesting enough for me. I would have liked to get the UK, the Belgian and the Swiss exposure, as well as the Eastern European exposure in small amounts, diversified that way. It's like it would have been very nice actually to get this exact set of geographic exposure. Would have been nice. So a little, it was a little bit of interest to me, partially just for that reason. I was kind of hopeful, but it is what it is. Let's do default risk, which isn't pretty at all. Default risk currently is 1.33. Pretty ugly. Look at it, I know that. This is rough. 4%. Holy crap. That is rough. Okay, so I guess that's gonna do it. A lot of meandering on this one, I know. I was trying to make sure I wasn't missing something here. just so weird to me that so many big top professional investors that I personally have a lot of respect in are apparently way, way, way off in their view of this compared to mine. I feel like I've been pretty generous. They must have a special situation involved in it. I just don't foresee. Yes, I don't know. All right, all right. So, LBTY, Class A of Liberty Global. U.S. Treasury is 1.54% today. Equity risk premium is 5.06%. We actually got equity risk premium over 5%. That's pretty crazy. Discount rate we get for this stock in particular comes to 9.85% after leveraging up its risk. Doesn't pay a dividend currently. 5 years ago, it had sales of $18.2 billion. In the most recent year of 2020, that was $11.9 billion, which is a compounded sales growth of -8% per year. Sales to capital ratio is 0.39%, which is pretty low. It's even low for its industrial average of 0.8. Returns on invested capital for the last several years on average has been about 12%. And they have a debt to equity ratio that's rather high at about 116%. Default risk is also relatively high at a current level of about 1.33%. And profit margins for the last 5 years on average, including a large payout from discontinued operations, just caveat there, comes to 15% or so, which puts them in line with their industrial average. They did have a profit in the most recent year. It was actually a loss, and they're currently selling for $28.91. On a probability distribution, we have it weighted much more towards the negative outcomes of things because of their expected sales decline. That does push towards a more negative outcome of margins as well, but it's hard to say what to expect on that. You could argue that perhaps this should be a little bit higher as a result because of the tail end probabilities that we put there. So maybe we'll make that last minute adjustment. But either way, so the probability distribution is tilted towards the negative end of things because we actually are expecting significant sales decline. I have sales anywhere from 6.3 billion to 2 billion in the 5-year forward period, which is sales expectations of -12% per year up to +5% per year on a distributed expected value of about -5% per year. We're assuming the sales to capital ratio will stay about the same at a 0.39, and the returns on invested capital, however, will be distributed pretty low because of the low sales to capital ratio, possibly only about 3%, which is way below their cost of capital. Debt to equity ratio we see as possibly actually increasing during the period, but that actually it's hard to say whether that's a positive or negative. I think they're possibly over levered, but it seems like leverage is the only way for them their business model to be reasonably profitable. Default risk as a result of that high leverage brings them to about 4% per year, which is pretty significant. That's a huge amount of default risk. And then profit margins I'm expecting about 7%. I'm expecting therefore profit about $723 million, which our present value based off the discount rate we're using gets the price of about $15.26. 5-year forward value targets anywhere from $9.90 to possibly $58.81. Distributed basis, I'm expecting $24.41. Based off the current price, gets expectation of -3.33% per year for the next 5 years, because it is 47% overvalued currently. Short-term pricing metrics shows that shows that we should expect it to be going up rather significantly in the short run. It's not including the growth rate, however, so I think they're probably throwing that off in the first place. But that could explain why some hedge funds are buying regardless, because they're thinking more about more cash. But this definitely looks like a very, very poor buy to me. Opposite of that, almost reporting. But it is. Maybe I'm wrong. Maybe there's some weird assumption here that's throwing the numbers off completely. But that's going to do it for us today. I stream 3 times a week, Monday, Wednesday, Friday, around the time that the market closes. I'm not sure which company we're going to be doing on Monday. I have my screening list of stocks that we've been kind of going through, but I've actually been working on a different screen provided through a third-party source that's been providing me the list of other stocks, especially foreign stocks. So I've been hoping to possibly with that. I've been narrowing down that list into like a top 7 to 10 or so, and I'll probably be starting to go through that at some point in the future. So I'm not sure which company or where I'm going to be doing next, but we'll be looking at something again probably on Monday. Either way, this has been Live Valuation. I'm Midas Moriarty. Please subscribe to the channel if you enjoy in-depth financial analysis like this, even if it is pretty quiet and looking through numbers half the time. But please subscribe to the channel.